$5,000 a month. Sounds good, right? The question is, how do you actually get there? And how much do you need to reach that goal? The answer's different for everyone, depending on where you're starting and how much time you have. But here's the thing, you can get there. And no, you don't need millions sitting in the bank to make it happen. In this video, I'm going to break down exactly how much you'd need. I'll show you why SCHD is one of the best options out there, how to use compounding to your advantage, and in the end, I'll show you and Josh how, no matter what stage of life you're in, you can retire close to a millionaire with a portfolio that pays over $5,000 in monthly dividend income. But before we jump into the numbers, let's set the stage and look at why $5,000 a month is such an important goal in today's economy. When people talk about earning $1,500 to $2,000 per month in passive income, the number sounds impressive until it's compared to the reality of 2025 living costs. According to the latest Bureau of Labor Statistics data from August 2025, the 12-month CPI increase for all items was 2.9%. Food prices rose 3.2%, and core inflation, which excludes food and energy, was 3.1%. Energy prices barely moved, up just 0.2%, but that small relief hasn't offset how expensive daily life has become. Those percentages show up directly in everyday budgets. U.S. households now spend between $900 and $1,000 a month on groceries. Essentials like eggs, milk, and meat remain higher than before 2020. Gasoline sits near $3.40 per gallon, and residential electricity averages 17 cents per kilowatt hour, both noticeably higher than just a few years ago. But the real budget breaker is housing, where things feel tightest. The median monthly rent across the U.S. in 2025 is about $1,539, up from roughly $1,470 just a year earlier. There is a massive climb from just 10 years ago, and it's outpacing income growth. Over the past few decades, rent prices have grown at an average rate of 3.9% per year. While wages have had a tough time keeping up, that narrow gap means paychecks aren't keeping up with housing costs. The data from the U.S. Census Bureau shows that the average rent now consumes 26.6% of the average American's income, up from roughly 24.5% in the early 2000s. That might not sound dramatic, but it represents thousands of dollars lost to housing inflation each year. In other words, more than a quarter of what the average worker earns goes directly to keeping a roof overhead, before utilities, food, or transportation are even factored in. Add in groceries, which now average $900 to $1,000 a month, plus utilities, transportation, and insurance, and it's easy to see how monthly living costs exceed $3,000 to $4,000 for a typical household. That means the $1,500 to $2,000 passive income barely covers half of basic living expenses in today's economy. It helps, but it doesn't create financial freedom or breathing room. That's why the goal needs to shift higher. Instead of aiming to just get by, the focus should be on creating $5,000 a month in dividend income, enough to comfortably cover essential bills and still enjoy life without constant financial pressure. And there's one ETF that's built a reputation for helping long-term investors do exactly that. Let's talk about it, SCHD, or the Schwab US Dividend Equity ETF. If you've spent any time around dividend investors, you've probably heard this name before. It's one of the most trusted, well-respected dividend ETFs in the US, and for good reason. Since launching back in 2011, SCHD has built a reputation for being simple, consistent, and seriously reliable. It focuses on large, high-quality American companies with a proven track record of paying and growing their dividends. In simple terms, it's designed for people who want a steady income, long-term growth, and minimal maintenance, all in one fund. The ETF is issued by Charles Schwab, one of the largest and most trusted financial institutions in the country. It's built around a simple but powerful goal: give investors exposure to reliable dividend-paying companies while keeping costs extremely low. SCHD's expense ratio is only 0.06%, meaning you pay just $6 a year for every $10,000 invested, a fraction of what traditional mutual funds charge. That efficiency has helped it attract more than $69 billion in assets under management. Now, how does SCHD actually pick the companies it invests in? It tracks something called the Dow Jones U.S. Dividend 100 Index. Don't worry about the fancy name. Here's what it means. This index looks for American companies with strong balance sheets, steady cash flow, and at least 10 years straight of paying dividends. In other words, businesses that know how to handle money and reward their shareholders even during rough markets. Right now, SCHD owns around 103 different companies spread across industries most of us rely on every day. Things like energy, consumer goods, healthcare, and tech. That mix gives it stability and balance. Some of its biggest holdings include names you probably recognize: AbbVie, Lockheed Martin, Cisco, Merck, ConocoPhillips, Coca-Cola, and Verizon. Together, the top 10 make up roughly 40.67% of the fund's assets. These are mature, cash-generating companies that have weathered recessions, rate hikes, and market swings, and still kept paying their shareholders. From a performance perspective, SCHD has done exactly what it's built to do: stay steady while the rest of the market runs hot and cold. Over the past year, SCHD's price dipped about 5.9%, while the S&P 500 climbed roughly 13.4%. Over 3 years, SCHD gained around 18.2%, compared to the S&P 500's massive 81.4% jump. And over 5 years, SCHD's up about 35.3%, while the S&P 500's gained 85.4%. At first glance, that might look like SCHD underperformed, but there's more to the story. The S&P 500's rise has been mostly powered by a handful of huge tech and AI-focused companies, the so-called Magnificent Seven. Their explosive growth in areas like artificial intelligence and cloud computing pushed the index higher, even though most other sectors didn't see the same kind of gains. It's also made the S&P 500 more volatile. Those 3- and 5-year returns include some major dips and recoveries. SCHD, on the other hand, is built differently. It leans towards steady dividend-paying companies like healthcare, consumer staples, and energy, sectors that have been slower lately. When interest rates stay high, those dividend stocks tend to lag because investors can get similar yields from safer assets like bonds. And that's exactly what happened through much of 2024 and into 2025. Another small factor was SCHD's rebalancing earlier this year. It added more exposure to energy and trimmed some financials, which temporarily weighed on performance. But that's just a normal part of how the fund adjusts to market conditions. When you look under the hood, SCHD's numbers tell a pretty solid story. The average company in the fund is huge, around $136 billion in market value. So we're talking about well-established businesses, not risky startups. Its price-to-earnings ratio sits around 18, which basically means investors aren't overpaying for the profits these companies make. The price-to-book ratio of 3.08 also points to fair valuation, showing SCHD isn't chasing overpriced stocks. What really stands out is profitability. The fund's average return on equity is a strong 28%, meaning the companies inside SCHD are really good at turning their resources into profits. A beta of 1 tells us it generally moves in line with the overall market, not more volatile, not less, and its 3-year standard deviation of 15.2% shows that its ups and downs are pretty manageable compared to other stock funds. When it comes to liquidity, SCHD really shines. It's rated A+, which basically means it's super easy to trade. On an average day, more than 16 million shares change hands, adding up to around $440 million in trading volume. It means whether you're investing a few $100 or a few $100,000, you can buy or sell shares quickly without worrying about big price swings or getting stuck waiting for a buyer. Now, let's understand how dividends actually work, how they grow year after year, and how reinvesting them can turn a modest contribution into a growing stream of income for life, because that's what SCHD is extremely good at. To understand how reinvested dividends accelerate long-term growth, let's look at a 5-year example. Let's say 2 friends, Josh and John, invest 10 grand in the same dividend-paying ETF. The fund grows about 6% per year and pays a 4% dividend yield annually. The only difference between them is what they do with their dividends. John takes his dividends as cash each year. In year 1, his account grows to $10,400. By year 2, it's around $10,824. And by year 5, he's sitting at roughly $12,248. That's a decent gain, about $2,248 in growth, plus around $2,200 in dividends collected along the way. Now let's look at Josh. Instead of taking the cash, he reinvests his dividends through something called DRIP, or Dividend Reinvestment Plan. Every time he gets a payout, that money automatically buys more shares of the fund, and those extra shares start earning their own dividends the next year. At first, Josh's results look identical to John's, $10,400 after the first year. But by year 3, his account's grown to about $11,700, and by year 5, it's sitting near $14,400, almost $2,200 more than John's portfolio. They invested the same amount in the same fund, earning the same yield. The only difference was what they did with the dividends. By reinvesting, Josh created a little growth loop. His money made more money, which bought more shares, which made even more money. That's the strength of compounding. It's not fast at the start, but it's powerful. Over just 5 years, reinvesting added about 15% more value to Josh's portfolio. Over 20 or 30 years, that gap grows into a completely different outcome, the difference between a modest income and true financial independence. Next, I'll apply this compounding principle to SCHD's data over 30, 20, and 10 years to see what it takes to reach $5,000 monthly dividends. Right now, SCHD delivers about a 3.83% dividend yield. Over the past decade, those dividends have grown at an average rate of 10.43% per year. So not only are you getting income, that income has been increasing every single year. On top of that, SCHD's share price has appreciated by around 7.69% annually. Now, let's see what that actually looks like over time. Let's say you've got 30 years ahead of you, plenty of time for compounding to do its thing. And let's keep it simple. You can set aside about $7 a day. That's roughly $210 to $220 a month. At the end of year 1, you would have invested around $2,555 in SCHD. This sets the stage for future growth. By year 10, your account will be worth around $45,000, generating roughly $2,000 a year in dividends. By year 20, your portfolio will be valued at around $207,000, paying out close to $11,000 annually. And by the time you reach year 30, things will look completely different. Your portfolio is projected to reach about $902,000, paying an annual dividend income of around $65,000. That's roughly $5,400 every single month. All of this will come from just $7 a day. Over those 3 decades, you'll have contributed about $76,000 in total, and time, patience, and reinvested dividends will have turned it into nearly $1 million. Now let's say you're in your 40s and you don't want to wait a full 30 years. You've got a little more money to start with and want to reach that same $5,000 a month goal faster. Here's how that could look. In the 30-year timeline we just covered, most of the growth happened in the final 10 years of the plan. That's the strength of compounding. It's slow at first, then it suddenly takes off near the end. But if you don't have that extra decade to let compounding work on autopilot, you can make up for it by investing a bit more upfront. To reach that same goal in 20 years, you'd need to start with an investment of around $60,000, then consistently add about $15 a day. That larger starting balance gives your portfolio the momentum it needs to grow faster and start generating meaningful dividends much sooner. Based on these contributions, by the end of the first year, your account will be worth about $72,000, producing roughly $2,300 in dividends. By year 10, your portfolio will be valued at around $284,000, producing close to $12,000 a year in dividends. That's roughly $1,000 every month. Those reinvested payouts from the earlier years will now be driving most of your growth, multiplying your income without any extra effort. And by year 20, your portfolio is projected to reach about $1.1 million, generating roughly $61,000 a year, or about $5,100 per month in passive income. Over those 2 decades, your total contributions, including the initial lump sum, will come to about $169,500. But through the power of compounding and consistency, that money will grow more than 6-fold into a portfolio capable of covering your living expenses for life. Now let's say you want to reach that $5,000 a month mark even faster, maybe within the next 10 years. You've worked hard, built up some savings, and you're ready to put your money to work. Here's what that could look like. Remember how in the 30-year plan, most of the big growth happened in the final decade? Then you boosted it by adding more at the start to reach the same goal in 20 years. But if you're working with a shorter timeline, like 10 years, you don't have that long build-up period. So, instead of relying on time to do the heavy lifting, you made up for it with a stronger start. That's why this plan begins with a $350,000 initial investment, followed by $50 a day. You're essentially front-loading your compounding, giving your portfolio enough weight at the start so it can generate meaningful dividends right away and grow faster over a shorter window. In the first year, your portfolio will be worth around $408,000, generating about $13,400 in dividends. Those dividends will immediately be reinvested, buying more shares and setting the stage for faster compounding. By year 5, your portfolio will be valued at around $725,000, producing close to $27,000 in annual dividends. That's just over $2,200 a month. By year 10, your portfolio is projected to reach about $1.41 million, producing roughly $61,000 a year, or about $5,000 every month in passive income. Across those 10 years, your total contributions, including the initial lump sum, will add up to around $532,500, but the power of compounding will more than double that amount in total value. This is the accelerated path, one that trades time for capital. It's built for investors with higher incomes or accumulated savings who want to create an income-generating portfolio within a single decade. Want to know how to earn over $8,000 in monthly dividend income using 5 compounding strategies? Click the video on screen to find out.